Hello everyone and welcome to my channel. Today I'm going to discuss banks are failing, what to do now. In the current financial system, a bank is considered to be failing if it is unable to meet its financial obligations and is at risk of becoming insolvent or bankrupt. This can happen for a variety of reasons, including poor management, risky investments, economic downturns, or fraud. In many countries, there are regulatory bodies that oversee banks and intervene when a bank is at risk of failing. These interventions may include providing financial assistance, restructuring the bank, or even closing it down if necessary to protect depositors and prevent systemic risk to the financial system. Following are top 10 solutions of banks are failing, what to do now. Before starting, don't forget to like and subscribe to our channel for more future updates. So, let's start. 1. Recapitalization. Recapitalization is the process of increasing the capital base of a bank, usually through the injection of additional funds or assets, to improve its financial position and increase its ability to withstand potential losses. This can be done in several ways, including issuing new shares to investors, converting debt to equity, or receiving financial assistance from the government or other investors. Recapitalization is often necessary when a bank's balance sheet is weakened by losses, a decline in asset values, or other financial challenges. By increasing the bank's capital base, recapitalization helps to reduce the risk of insolvency or bankruptcy, improve the bank's creditworthiness, and restore confidence in the institution. However, recapitalization can also have downsides, such as diluting the ownership of existing shareholders, reducing earnings per share, or increasing the cost of capital. 2. Restructuring. Restructuring refers to the process of making significant changes to the organizational structure, operations, or business model of a bank in order to improve its financial performance and stability. The goal of restructuring is to create a leaner, more efficient, and more profitable organization that is better equipped to compete in a challenging market environment. Restructuring can involve a wide range of changes, such as downsizing the workforce, consolidating business units or divisions, reducing overhead costs, divesting non-core businesses or assets, or outsourcing certain functions. The specific restructuring measures that a bank undertakes will depend on its particular circumstances, including the nature and severity of its financial challenges. Restructuring can be a complex and difficult process, and it often involves significant upfront costs and disruptions to the business. However, if successful, restructuring can lead to improved profitability, enhanced competitiveness, and a more sustainable business model. 3. Improving risk management. Improving risk management is a critical component of a bank's overall strategy for ensuring its financial stability and long-term success. Risk management refers to the process of identifying, assessing, and mitigating risks that could impact the bank's financial performance, including credit risk, market risk, liquidity risk, operational risk, and other types of risk. To improve risk management, banks should implement rigorous and effective risk assessment and monitoring processes, establish clear risk management policies and procedures, and ensure that all employees are trained on risk management best practices. 4. Asset sales. Asset sales refer to the process of selling a bank's assets to generate cash, reduce risk exposure, or streamline operations. Assets that may be sold include non-core businesses, loan portfolios, real estate, securities, and other assets. Asset sales can be an effective way for banks to raise capital and reduce risk exposure, particularly if the assets are underperforming or not central to the bank's core business activities. By selling these assets, banks can generate cash that can be used to pay down debt, reinvest in core business activities, or provide a cushion against future losses. Asset sales can also help banks to streamline their operations and focus on their core business activities. This can lead to improved efficiency, reduced costs, and better financial performance. 5. Mergers and acquisitions. Mergers and acquisitions, M&A, refer to the process of combining two or more banks or financial institutions into a single entity through a purchase, merger, or consolidation. M&A can be an effective way for banks to achieve growth, improve profitability, and increase market share, particularly in a highly competitive industry. M&A can take several forms, including horizontal mergers between banks operating in the same market, vertical mergers between banks operating in different stages of the same supply chain, and conglomerate mergers between banks in unrelated businesses. 6. Government intervention. Government intervention in the banking sector can take many forms, including regulatory oversight, capital injections, loan guarantees, and direct intervention in troubled banks. The primary goal of government intervention is to promote financial stability, protect depositors and investors, and prevent the spread of financial crises. Regulatory oversight is one of the most common forms of government intervention. It involves the establishment of laws and regulations that govern the behavior of banks and financial institutions. These regulations may address issues such as capital requirements, risk management, liquidity management, and consumer protection. 7. Debt restructuring. Debt restructuring refers to the process of renegotiating the terms of a bank's outstanding debts to improve its financial position and avoid default. Debt restructuring can take many forms, including extending the maturity of existing debts, reducing the interest rate on outstanding loans, and converting debt into equity or other securities. Debt restructuring can be an effective way for banks to address financial difficulties and avoid insolvency. By restructuring their debts, banks can reduce their interest and principal payments, improve their cash flow, and avoid default or bankruptcy. Debt restructuring can also help banks to avoid the costs and negative consequences of liquidation, such as lost jobs and reputational damage. 8. Cost cutting. Cost cutting is a process in which banks take steps to reduce their operating expenses and improve their financial performance. Cost-cutting measures can take many forms, such as reducing staff, closing branches, outsourcing services, or implementing new technology to automate processes. Cost-cutting can be an effective way for banks to improve their profitability and financial stability, particularly during times of economic uncertainty or increased competition. By reducing expenses, banks can improve their efficiency, free up capital for investment in core business activities, and increase their competitiveness in the marketplace. 9. Diversification. Diversification is a strategy that involves expanding a bank's activities or operations into new markets or products in order to reduce risk and improve its overall financial performance. Diversification can take many forms, such as expanding into new geographic markets, introducing new products or services, or investing in new business lines or subsidiaries. The goal of diversification is to reduce a bank's dependence on a single market or product, which can leave it vulnerable to fluctuations in that market or product's performance. By diversifying, banks can spread their risk across a broader range of activities or markets, which can help to stabilize their financial performance and improve their long-term prospects. 10. Strengthening corporate governance. Strengthening corporate governance is a process in which a bank improves its management and oversight practices in order to ensure that it operates in a responsible, transparent, and accountable manner. Strong corporate governance is essential for ensuring that a bank's operations are aligned with the interests of its stakeholders, including shareholders, customers, employees, and regulators. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comments section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.